First of all, in the UK, the private rented sector, it's had a lot of attention, in the media, but no real response as yet. It's a relatively undeveloped sector in the UK, but one where we're seeing increasing tenant demand. And generally, we like to invest in buildings where there's strong tenant demand. And here we feel that there is pent-up demand in that the supply response has been slow. With increasing house prices, it's been progressively difficult for people to get on the home ownership ladder. And so by providing private rented housing, and I'm not just talking about London, I'm talking about nationwide, we are providing something, or will be providing something that there is tenant demand for, and ultimately create a strong investment product.
I think on the capital side, the types of investors who are interested in the strategy that Simon's describing are going to be the kinds of investors who are interested in a stable cash flow. It's not going to be the highest yielding cash flow in the market, but it should be a very stable cash flow with good predictable income growth and hopefully residual value over time. So at least we see that investor base being primarily UK institutional investors, with probably some significant continental European institutional investor interest, as well as they look at where interest rates are relative to these returns, and they should be very stable.
We are a big fan of retail. We have a lot of expertise in the retail sector. But what we're seeing is an opportunity in the urban retail space and dominant urban retail. I think in the recent past we've seen a lot of people focus on the mega malls, but this is all about capitalizing on urbanization, the migration of people towards the city, and giving a response, a retail response to what those people are demanding. The centres that we've been seeing are capex starved, so there's an opportunity really to position them, upgrade, and capitalize on the urbanization themes that are going on.
Not so dissimilar from the UK private rented sector. The stability of cash flow, maybe a little bit higher yielding than the PRS sector, we think will be attractive to investors. Probably French and other continental European institutional investors, pension funds, insurance companies, attracted by the yield differential between the retail and bonds. In this case, it's really hard to get your hands on retail unless you're investing in shares of the big unibuys of the world. So we think they're underweight retail and will be attracted to this, and that will also appeal to some of the big, particularly Asian sovereign wealth funds, because they don't have much retail and can't get hold of much retail. So they should find that very interesting.